Hello and welcome back to Tenet's panel discussion on the impact of pension reform introduced in April 2015. I'm Jill Davidson, Tenet's Group Regulatory Director, and I'm delighted to introduce you to today's session where we're going to be looking specifically at clients' income and expenditure. We've listened to many of your questions and I hope that today's expert panel will be able to bring you a number of answers. Let me introduce you now to Steve Jones.
Hello, I'm Steve Jones, Head of Relationship Management, and I'm again joined today by Charlotte Willis, Competence and Compliance Manager, Simon Thomas, Head of Policy, and Ben Wright, Head of Technical Services and Research. Today we're going to be looking at expenditure and why it's so important to get the details. So a lot of clients won't really know the details of their monthly spend. Why is it not acceptable to just use an overall figure?
Okay.
Charlotte.
The fact that most people don't know their overall expenditure figure is the reason why the questions need to be asked. If you don't know what the client's expenditure needs are now and how that might change in retirement, how are you able to plan for what their income needs are actually going to be? You need to make sure that you're working towards the right figures so that you're not generating too much or too little income. For example, if the client has already got an IHT issue and they're taking income from a plan that's not going to be spent, then potentially you're moving it from an environment where it's very tax favourable to where 40% of it could be lost in inheritance tax. I think for ultra high net worth clients, then it's still a sound exercise to undertake, so those clients can have a full detailed understanding of what their expenditure is going to be. However, where it's absolutely obvious that their essential expenditure is covered by existing income, then it's acceptable to use an overall figure for expenditure.
Okay, so engaging with an advisor will help clients understand, or should help clients understand their monthly expenditure, comparing that to income and so on. How will this work? How can it help?
Well, an advisor can really act as a coach in this instance. If you sort of face with a client who really doesn't know what they're spending on a monthly or regular basis, then you can help the client by taking them through the bank statements, looking at what the regular bills are. You can sort of derive from that gas, electric, council tax, the kind of fixed expenses which are unlikely to change even in retirement. And then, the client's checkbook or even sort of loose receipts, which they've sort of accumulated in the wallet as you do. Just keep a note of those expenses, and you build up a picture of what the client is spending on a regular basis.
And also, it may be worth kind of talking through any kind of social activities that they do. So hobbies and interests, holidays, that type of thing, and just trying to get them to open up by talking about the personal aspects of their life. You could even ask them, what did you do last weekend? Or when's your next holiday planned? Or whereabouts are you off to? Just kind of really open questions that work into the personal angle.
In terms of income to take into account, the short answer is everything. As well as regular pension income. Don't forget income sources such as investment returns and investment income, dividends, entitlement to trusts and any entitlement to state benefit. When you add all these together, it could mean that the client needs to actually take less from their pension.
Okay, and recently I think, Ben, the Tenet's recommended that advisors split out essential and desired expenditure. Why is that so important?
Well, if you think about your own expenditure, I think most of us have got kind of two categories really when it comes to your outgoings. You've got the stuff that is essential, you have to pay it, so that's like your council tax, your gas, electricity, that type of stuff. And then you've got your desirable expenditure, which is like holidays, socialising, that type of thing. By splitting those into two distinct groups, it makes it much easier to kind of see how your income will be apportioned. And also, if you look at kind of a blended solution towards retirement, it may be that your essential expenditure you could cover with something that provides a fixed level of income, like an annuity or third way product. And then your desirable stuff, which you don't need but you would like, you can take a more flexible approach, like with maybe income drawdown. The danger if you don't separate the two is that your client's income could just seem unachievable. So, you know, if I say I need to generate £2,000 a month and that's it, that's the figure, it could be that there's no chance at all of doing that. Whereas if you break things down, it could be that actually the £1,000 of essential expenditure can be met. So it's just the £1,000 of discretionary that you might need to take a little bit of a bit more thought over and get the client to kind of reconsider how much they will need to spend.
Of course, remember though, if the client can't cover their essential expenditure, then that's a much bigger issue.
True. Yeah.
So again, it's the devil's in the detail. You know, it will make a big difference towards the recommendation if we get that analysis correct. So how will that change when you move into actually living in retirement?
It's a good question. I think it's probably a good place to start with what won't change. So whilst your mortgage may be paid off when you get to retirement, certainly for a lot of people I think it will be, you will still need to pay your council tax, pay your gas, your water, electric. So there's kind of a core expenditure which will remain no matter what point in your life you're at. On the flip side of it, discretionary expenditure probably will change. Now, I don't know about you, but if I think about the time of the week I spend most money, it's the weekend. When you're retired, and really every day is the weekend. So there is a real chance that discretionary expenditure could go up quite significantly at that point. You know, travel, hobbies, things like that. Although, you know, commuting to work, that kind of cost, buying new suits, that will stop. So it will change.
Yeah, I mean, I think the important thing is to try and get a grip of your spending. You know, find out where the leakages are. Yeah, everything counts. You know, don't forget those little habitual expenses. You know, if you're going to work and either you regularly pass a coffee shop and you regularly stop and buy a coffee on the way to work, and another one on the way home. Yeah, that sort of amount. Yeah, those £2.50. Yeah, adds up throughout the week. You know, that's 10-15 quid. That you've spent without even sort of feeling it, and certainly, you know, my sort of experience as an advisor used to come across clients who would start off the week with 100 quid in the wallet, and they'd end up at the end of the week and there was nothing left in the wallet, and they didn't really know where the money had gone, but it had gone. So you know, it's good to encourage clients to try and keep more of a track of what they're spending, and then they can apply that in terms of, well, I'm not going to be passing the coffee shop on a regular basis, so I'm actually not going to be spending that, but I might be going of a weekend or late morning, and I might sit there and I might sort of use their paper whilst I'm having my coffee. So the pattern of expenditure will change, but it's getting the client to think about what their life will look like in retirement. As opposed to what it is now. So some clients may sort of come to you and they present quite an unrealistic picture of what their expenditure is going to be, and they'll usually underestimate what those little essentials are. So if you can get that breakdown, you can understand it more fully and have a discussion with the client. I mean, ultimately, if the client is adamant that their essential expenditure is going to be at a certain level, then that's what you need to work with. But don't be afraid of actually sort of challenging the client in a sort of helpful, consultative manner, and just sort of get them to consider carefully what they're setting as those sort of essential levels.
Yeah. I mean, I think the real key message here is that every client's retirement expenditure will be different. That's why it's really important to plan it out with them. And a cash flow analysis is a great way to do this.
Yeah, and we're hearing a lot more about that over recent months, cash flow analysis, cash flow planning, lifetime cash flow planning. So it's obviously becoming an important part of an advisor's toolkit. How, in your experiences, do advisors introduce that into the advice process?
I think the key thing when introducing anything new to clients is explaining why you're doing it and the benefit to them as an individual. The cash flow tool can be seen as kind of a storyboard for the client's finances in retirement. You can show your starting point, you can show the ups and downs, the bumps along the way, and you can show in theory where the end point is. It can be the most important part of any financial plan, I would think, because you can really demonstrate the value of that advisor coming to see you as an advisor. Sorry, that client coming to see you as an advisor, and you can show them, their path in retirement. Now, like many tools, it can be abused. So the danger with cash flow modelling is if you use unrealistic assumptions, over-ambitious growth rates, or underestimate things like charges or inflation, the picture that comes out can be very rosy indeed, but not particularly accurate and not very real-worldy. It can also kind of give the clients a false sense of security, and that just end up in problems later on when the investment's not on track to produce what it's designed to produce. They come back and ask why they're in that position. Also, cash flow analysis is not a one-time exercise. It's something which should be an ongoing thing, which is updated throughout a client's retirement. You take into account any changes that happen along the way, and sometimes you can replan. If priorities shift, you can rework on that. It just gives really a kind of a graphical representation and also just a bit more than a finger in the air as to how long income's going to last in what kind of condition.
It's also important to remember that the tool is only a model representation based on reasonable assumptions. It's a starting point from which to plan from, but the outputs are not guaranteed, and that should be covered with the client.
That's very true indeed, Charlotte. By identifying the client's financial position, getting the truth about their expenditure and their income, money habits, all that side of things, you can put together a plan which will really kind of be specific for the client. It will hopefully last them throughout their retirement and achieve their goals. And you can demonstrate that using the assumptions built within the modelers and show that to a client. Also, if it's not looking like things are achievable, it's much easier to say, rather than just coming straight out and saying you can't do that, you can show them the output of the cash flow modeler and saying, this indicates that your goals are not achievable. Where do we go from here, and what can we work on together?
So one of the regulators' favourite phrases at the moment is putting the client in an informed position, and by using one of these tools, that really helps that process. So Tenet have recently launched their own cash flow planning tool. Do advisors need to use that?
No, there's no requirement to use the Tenet tool. The idea behind building that tool was to give our advisors something which they can use for cash flow analysis with clients, and it fits seamlessly into our advice process, our fact-finding, and also our suitability templates. However, there are great proprietary systems on the marketplace, including a cash flow modeler within Tenet Advantage, the Pro version. As well as this, there are some more limited tools available in the marketplace from providers, and they're really designed to be used with their individual products or funds, which is absolutely fine if that is what you're looking to do. The key thing to remember is to understand how the tool works, understand the assumptions within the tool, and be able to explain that to the client when you're talking through the outputs.
Yeah, there is a requirement for those advisors who, within the AR network, have applied for the dispensation that we talked about in one of the earlier sessions. Then we do require a tool to be used in those circumstances, but we don't mandate that it's got to be the Tenet tool. Looking at this through a regulatory lens, the use of things like the cash flow analysis tool is not dissimilar to the tools that were brought out for attitude to risk, which we're quite familiar with now. But the FCA did some themed work around that a number of years ago now, and I think some of the points that they raised are probably still relevant now to the tools. So you need to understand, what are the inputs, where are the weaknesses, where are the holes, so that you can actually sort of understand whether the information, not only that you're putting in, but also what the output is and where the gaps and potential pitfalls might be. And I think the other thing to watch for is that, as Ben said, you can change some of the inputs and the assumptions. By doing that, actually, that gives you a tool which you can almost magically make a solution possible by adjusting the assumptions. So if you knock the inflation down to 1% and the growth up to 8%, then all of a sudden, everything becomes possible. But it's not terribly realistic, and you're presenting false expectations there to the client, and it's where clients' expectations are thwarted that they tend to feel a bit grumpy, and from that sort of source, complaints can arise. So be really careful about how you use the tools, but do understand them. They are really powerful.
And they presumably need regular review with the client.
Absolutely, yeah. As Ben said, it's not a one-time and done. This is a really good tool for taking to the client at the next review, walking them through what has actually happened, replugging that into the tool, and then reforecasting and say, right, okay, are we good to go now?
Whilst cash flow analysis can seem new and daunting for some, there are firms within Tenet who've embraced cash flow planning over the last few years, and it's revolutionised their business. Whilst the use of a tool is not mandatory, it can really show your clients how much value you can add to their retirement.
Okay, so in summary, it sounds like the deployment of a good cash flow analysis tool adds value to the advice process, identifies opportunities, is real benefit to clients. And we know, as you said, Charlotte, that many businesses within the Tenet group have successfully deployed it in their own businesses with a good degree of success. So, yeah, good. Okay. Charlotte, Simon, Ben, thanks very much.
Thank you.